In the world of money, there are two great fears. The fear of missing out. That rocket ship stock everyone is talking about. The one that could make you rich overnight. And the fear of losing it all. The sudden crash, the devastating correction that wipes away years of hard work. We are taught to pick a side. Are you a gambler, chasing growth at any cost? Or are you a miser, hoarding value and terrified of risk? For decades, this was the brutal choice facing every investor. But what if this choice was a lie? What if the single greatest secret to building lasting wealth wasn't about choosing a side, but about finding a hidden path right down the middle? This is the story of a quiet man who survived the Great Depression, turned his back on Wall Street's noise, and created a simple philosophy that would quietly grow into a $1.5 trillion revolution. This is the story of Rowe Price and his timeless lesson on buying the future, without overpaying for it. Thomas Rowe Price Jr. was not your typical Wall Street titan. He wasn't a slick salesman or a ruthless trader. He was a chemist by training, graduating from Swarthmore with a degree in chemistry in 1919. He saw the world in terms of compounds, reactions, and underlying principles. And when he looked at the wild, roaring stock market of the 1920s, he didn't see a party. He saw an unstable chemical reaction waiting to explode. He took a job at a brokerage firm, but felt like a fraud. He was told to push stocks he didn't believe in, to sell the sizzle, not the steak. All around him, shoeshine boys were giving stock tips. The hype was intoxicating. But Price's methodical mind saw the danger. He saw companies with no real earnings, no real innovation, being bid up to insane prices. It didn't make sense, and then, in 1929, it all came apart. The crash wasn't just numbers on a ticker tape for him. It was a scar. He saw fortunes evaporate. He saw the lives of hardworking people destroyed by speculation they were told was a sure thing. While others were jumping out of windows, Rowe Price was taking notes. He realized the entire system was broken. The focus on short-term trading, on tips and rumors, was a fool's game. He decided there had to be a better way. A way to participate in the inevitable growth of great American companies without getting burned by speculative mania. In 1937, in the heart of the Great Depression, he did something radical. He founded his own firm, Rowe Price and Associates. His core idea was so simple, it was revolutionary. He would only invest in companies that were poised for long-term growth. Companies with durable products, smart management, and a massive potential market. But here was the critical twist, the secret ingredient that separated him from the gamblers. He refused to overpay. This was the birth of GARP, growth at a reasonable price. Think of it like this. A value investor, like his contemporary Benjamin Graham, might look for a struggling, unloved company selling for 50 cents on the dollar. They're buying a bargain today. A pure growth investor might pay $10 for a company that's only worth $1 today, betting it'll be worth $100 tomorrow. Rowe Price did neither. He looked for the $1 company that was on a clear path to being worth 10, and he was determined to buy it for $1, or maybe $1.25. He wanted the growth, but he demanded a fair price for it. He was buying tomorrow's giants at today's sensible prices. He wasn't looking for cheap stocks. He was looking for great companies that happened to be reasonably priced. He invested in names that were then innovators. Companies like IBM, 3M, and Merck. He didn't care about the Dow Jones Industrial Average. He cared about the individual business. Was it growing? Was it leading its industry? And most importantly, was its stock price still connected to reality? He was a patient man in an impatient industry. He held his positions for years, even decades, allowing the power of compounding to work its magic. He famously said, "It is better to be early than to be late in recognizing the passing of a corporate dynasty." He knew that even the greatest companies could lose their way, and he wasn't afraid to sell when the growth story changed. His firm was also one of the first to charge fees based on a percentage of assets managed, not on commissions from trading. This was radical. It meant he only made money if his clients made money. His success was directly tied to their success. He wasn't a broker, he was a partner. For decades, his philosophy was the quiet engine of wealth creation for millions. It doesn't have the swashbuckling appeal of a hedge fund trade, and it won't make you a millionaire by next Tuesday. But its power is undeniable. It's a philosophy built on prudence, patience, and a profound respect for both potential and price. So what does this mean for us today, in a world of crypto, meme stocks, and AI hype? It means more than ever. The core conflict between greed and fear is alive and well. Rowe Price's lesson is the antidote. Before you buy any investment, ask yourself two simple questions. First, is this a truly great business, with a long runway of growth ahead of it? And second, is the price I'm paying today a reasonable one for that future? If you can answer yes to both, you're not just buying a stock, you're investing. Moving beyond the noise of the crowd and applying a timeless principle for building lasting wealth. The world will always present you with shiny objects and terrifying headlines, but wisdom is the shield that protects you from both. If you want to continue discovering the timeless financial wisdom from history's greatest minds, make sure you subscribe and join our community, and let me know in the comments. What's one company today you believe Rowe Price would have invested in?